put on the front page.
Well, I swear by them.
Yeah, there you go.
By or at, I get confused.
I want to turn to MJ Lee from Politico for a moment. She's got a question for you regarding, we're going to talk a little bit about regulation and too big to fail, and I wanted to bring in MJ for a question for Lloyd Blankfein.
Hi, thank you for taking my question. In the too big to fail debate, there's some skepticism about whether regulators can use their new powers to seize and liquidate a big bank that's on the brink of collapse.
No, speak slower because of the echo.
In the too big to fail debate, there's some skepticism about whether regulators can use their new powers to liquidate a big bank that may be on the brink of collapse. Do you personally think, based on your work with the FDIC and the Fed, that if Goldman were to run into serious trouble today, that regulators would be able to liquidate your company?
They would. I don't think there's any appetite today to do anything other than to allow a company to be liquidated. The reason why this is so much in in the debate and top of mind is people want to be able to. It's not a question of whether you want to liquidate it or not. The question is, how can you liquidate it so that you don't do damage, so you do less damage to everybody else in the world? But there's no doubt that companies, debate too big to fail. Companies are going to fail. If anybody thinks there's a political will to rescue failing financial institutions, you're not reading the same papers I'm reading, and you certainly aren't getting the same stimulus that I'm getting from the regulatory side or my connection with the political body. There's no appetite to do anything other, but the mechanisms are being debated on how to have that done and how best to protect the taxpayers in a way that will all simultaneously do little violence as possible to the economic system, because these institutions like ourselves are systemically important, and the way in which the focus is being generated now is to make sure that institutions like ourselves have enough capital and enough debt that can be risk absorbing in the right parts of our company, no easy thing to do, in the right jurisdictions, no easy thing to do, that will absorb any conceivable losses, so that any effort that's made to sustain these companies for a period of time so they could be liquidated in an orderly way doesn't result in any net losses to the public, because there'll be enough risk-bearing capital to overwhelmingly and assuredly keep the taxpayers harmless. That's the consensus goal of everybody. We're working our way towards that, but it's hard. And by the way, it won't be tested till it's tested. So people will rattle around, and some people will say this can work, some people say it can't work, and we won't know for sure. I'm not dying to test it, that's the best minds that the regulators have and we have in our own company are working together to try to make that work. Nobody wants an institution too big to fail, and let me tell you, if that weighs as a burden on society, it would be a big burden on us to bear that, because look at the consequences of being deemed too big to fail. People say you get a subsidy, people say this, you don't deserve what you're doing yourself, et cetera, et cetera, et cetera. The ramifications for that are very extreme, and we could debate whether we are or aren't, but let's just work to make sure that we're not.
And just to follow up on that, I mean, do you think that there continues to be a subsidy for the biggest banks, both in terms of the presumption that there still will be bailouts, regardless of what regulators say, that if we get into a disastrous crisis and a Citigroup, Goldman, Morgan Stanley, all are on the brink, they won't be bailed out? One piece of the subsidy, the other, the funding subsidy, which there are conflicting studies on whether it exists and what the size of it is. But do you think there are still unfair advantages for a Goldman over a smaller bank?
I think there are advantages for big companies in an industry versus small companies in an industry. So in any industry, big companies that are big, diverse, very well capitalized, are operating in different regions and different products, are safer credits, and generally fund at a lower price than the smaller companies in their industry, whether that's chemicals, oil, or finance. And so if you say Goldman Sachs funds more cheaply than undiversified, smaller banks that may have multiples of their balance sheet focused in one asset class, namely local real estate. But all that difference is explained really by the credit consequences of being smaller, less diversified, and having less liquid debt outstanding. So I think we fund more cheaply, but so would a GE in its industry versus smaller companies in its industry. That's explained like that, and we've just recently published on that. It's on our website, and you're right, the debt's been put, but I recognize that some people express it as an axiom. Right. I will say that if you're looking to buy someone's debt, whatever the too big to fail or whether an institution will be sustained, the equity is going to get wiped out, and the unsecured debt is going to get a haircut equal to how much it takes. In other words, there are normal principles that's risk absorbing. So if you're going to buy debt, you don't think, gosh, come hell or high water, I'm going to get my money back. You're not. And so it trades. We don't trade at the same debt cost as a JP Morgan or any other thing. There's a whole gradient. We're not all trading at the credit of the United States. So I think that's false. We've now put in our own studies and challenged other people's work on the topic. And so, it's now out in the marketplace of ideas and people can engage on that. But I think it's a false issue. Okay,
but if, say today, we have the sell-off in the Nikkei, we're to go global and have a great big sell-off in U.S. markets, we get into another financial crisis very soon, and a bank like yours is teetering on the brink, would the federal government allow Goldman Sachs to fail?
It depends what you mean by fail. I don't think it would be allowed to. I think there would be an orderly liquidation, and the emphasis is on orderly. So there would be my guess is, there would be some extension of liquidity as the equity and part or all of the debt were being wiped out. Now, if you're an investor in our company, you would consider that a failure. But it would be kept liquid long enough so people who owed contracts to and from it would able to get out and be liquidated on an orderly basis. So there may be an extension of liquidity, but it won't benefit the equity holders or, to some degree, the debt holders of the company. So it will look like failure to them, which is what you want, but it won't be a immediate vaporization where everybody in the world has to replace their contracts, as occurred in Lehman Brothers. So will be a liquidation, but they never say liquidation without the qualifying word orderly, and that's what people should want. So the emphasis should be on making sure that the taxpayers never foot a bill, but don't forget there's still a concept of lender of last resort, that in a kind of confidence industry with a fiat currency that has its value because people say it does and people stand behind it, there will always be a kind of a liquidity provider of last resort, but the emphasis should be they're never losing money on it. They're just merely providing liquidity to the system.